Hi, this is Randy Finney with the Right Side of the Chart, and today is Tuesday, December 12th, 2023. What I'm going to do in this video, we're going to take a look at three different indexes. We're going to start with the VIX Volatility Index, and then take a look at the S&P 500 and Nasdaq 100. I'm not going to go over a ton of charts. What we're going to do is just a kind of big overview of the VIX. And then on all three, the VIX, S&P 500, and the Nasdaq 100, I'm going to study those PPO sell signals that I've highlighted recently. As we still do have both those sell signals intact, although almost by a hair right now. I'll get to that in 1 second, show you the posture of the PPO. But we're going to study, more importantly, the history of it. And then also look at the same thing in reverse on the VIX. You know, one way to look at the VIX volatility index, it's almost looking at the S&P 500 in reverse. When the stock market goes up, especially when it's low volatility period, the VIX is falling. And then the VIX has its spikes. The VIX, when you look at it here on a weekly chart, that's what we're looking at. We're going back into the 90s, mid 90s. We're looking at a couple decades here. It's kind of like a quirky EKG. And so it does have, in my opinion, some predictive value. First of all, it's an incredible trading vehicle if you get the timing right. However, just like short selling, you have to be more precise than long side traders. Long side traders, especially in a bull market, will get bailed out even if they have the absolute worst timing skills. Short sellers have to be more precise on their entries and exits. And the same thing when trading the VIX. It is far from a buy and hold vehicle. If anything, you just find one of those VIX ETFs and you just short it and just capture the decay and the fact that those are always going to lose value over time. All right, but let's look at this chart again, weekly chart, things I've covered in the past, but I think it bears repeating. Back here, this was the dot-com bubble in the 90s. It popped in, the markets peaked in 2000. This is where the VIX would end. Even those, we had they called it the Asian contagion in 1998 right there. Along the way leading up to the bubble was a big drop in the market. But this is where bear markets and or big corrections ended. That was and you can see it was very clear. You have a few spikes into that level. Then we had the next bull market. And then, as you can see, as I scroll forward in time, I've had this here for a long time. I've noted that since the last, or the bull market that started in March of 09. Remember, this whole thing here was the Great Recession, the bear market from 07 to 09. It was October of 07 to March of 09. And that's what it looked like. That's what the VIX did. And then after that, in March of 09, after we peaked here, we started a new bull market that it was the only bull market, in my opinion, up until the beginning of 2022, or if you're looking at the Nasdaq, November of 2021. And again, to me, it's been very clear. There's been a few corrections along the way that, again, I consider corrections, not bear market. Even COVID falls in that category. It'll go down in history as a bear market, but when you have a 36% drop in the S&P 500 that's over in 6 weeks, I call it a correction, or really I call it Ursa interruptus, bear market that was interrupted, not allowed by the Fed and the federal government. But either way, you can see clear levels. These are the big drops, and you can just compare this if you want to. You can look at the timing down here, and you can see the corrections if you overlay the S&P 500, look at it over those periods, and then that's what happened during COVID. Okay, so number one, I'm sure some others have maintained, we never saw, when the market bottomed in October of, I'm talking now, fast forward, in October of 2022, well, when the markets bottomed, the S&P, the Nasdaq, we never saw anything remotely close to that getting back to just where corrections in the last bull market ended. And this is as high as we got right here. I have a resistance level, but again, these are the spikes that ended previous corrections, and or if you want to call them bear markets, and we never saw that. Okay, so what does that mean? Well, it just tells me, and a lot of, that observation was made by many others. We never saw that kind of capitulation, throw in the towel moment that is almost a signature. It's always been a signature of every bear market, really, pretty much in history. Again, if you want to count COVID, sure, you can count that one. Okay, but the takeaway more so is this. This is the posture, the current posture. Over time, we have different floors. in the VIX. Back here in the 90s, leading up to the dot-com bubble, it was a higher floor, and you'd buy pullbacks, and that's where all the spikes started from. Then we hit a period of unprecedentedly low volatility there. You had it here again. You had just a brief spike down to that level and a brief spike there. So that will go down, or at least now, as of now, is the extreme bottom range. And again, we've only seen it in periods right there right before the bear market started. Remember, I told you it was October of 2007, and then you saw one back here in 2018. It dropped to that level, but you can see I do have lines. This is a range really right here, a support zone, other than those two very brief and fleeting spikes down below. And we're close to that now. We're not all the way there. You can see I have the line at about 1150, and it's not a hard line. There's some punches through there. You also have a signature of all these big spikes. Not all of them, but most of them, especially the big ones, is positive divergence. So again, when you're looking at the VIX, quite often it's a mirror image of the S&P 500 upside down. And just like you have the negative divergence on the stock market right now, on the weekly time frames like this, you have it also positive divergence on the VIX, just like you had positive divergence right here, and then you had that huge spike right there. And these spikes are measured in the very high double digits. They're not 5-8%. They're 30, 40, 100% plus spikes that you get in the VIX. It's just the nature of that beast. So anyway, again, probably the biggest takeaway is that. And then where we're at right now, the fact that we never got up to there since the markets peaked back here. That's as high as the VIX got, far from where previous bull market. It just showed, again, there wasn't that much fear. It's the old Fed put. The market is putting a tremendous amount of faith that the Fed has finally figured out the magic cure and will never ever have a recession again, or worse, depression, because the Fed has figured out the secret to success. So they've eliminated the business cycle. For those of you not familiar what that is, it's economics 101. The business cycle. Economies go through periods of expansion or growth, and followed by contraction. Those are your recessions, and they're very healthy and necessary. The analogy that I've used for years is like the prescribed burns from the forestry department. I'm in Florida here, but you guys have them in California too, in dry areas where in the dry season, anytime throughout the year, the forestry service will go in and burn down areas, a lot of undergrowth and shrubbery to prevent the bigger fires, because that's fuel when the dry season comes. And so it's a necessary thing. And the same thing when you have a recession, it just purges out companies that need to be purged out to have a more firm footing or foundation in the economy. Think widgets. You open a widget company in USA, and you're making money, and you've owned this company for you and your family. It's family-owned business, 50 years. But all of a sudden, in this era of free, easy money, now you have 30 widget companies and competing against you. Some don't know what they're doing, and they're underpricing, and they're able to stay in business because you can keep borrowing pretty much at near zero rates. And what it does, it just puts pressure on everybody. And the longer that continues, then even though the well-run 50-year business, with good management just can't compete, and it's bad for everybody. So the recession does it. It purges out those, and then the companies that emerge from it come out stronger. And let's jump down to a daily chart here. Okay, so more important. That was bigger picture, but on the daily, nothing's changed for a while now. Let's see, little bit of a busy board, but I'm just going to recap. We had this trend line right here. This trend line here. Uptrend line that comes all the way back from June of 2021, and that was taken out. We took it out, and that's what brought us down to this new floor. Remember, this is long-term support, these two blue lines. Hopefully you can see it here. Let me park this PPO histogram. This is taking up too much space on this chart. Okay, so there you go. This is, just to kind of recap the VIX. And that's what you want to look at. What is the recent, not the historical low end of the range, It doesn't matter what it was doing back in the 90s. This is the current range in recent years in current market conditions. This is a very good support floor. You can see here, I've had it labeled as such. We had a lot of spikes off the VIX, and they typically occur with these divergent lows. You get a spike, divergent high, you come back in. So these spikes up are stock market pullbacks, corrections, and even there was COVID right there. And there was when the Nasdaq bottom or topped right there. It was in November. You had that first lift up. And here's where we're at. So we are at support at the top of the support range with positive divergence. I will address this, that this is a type of market I've seen and been through many of these where it just is almost bulletproof. It just defies divergences. It's also walking up on low volume. It's got a holiday bid behind it. The volumes have really tapered off, and I think shorts have left the building for now and given up. Again, I'm going to show you what I see. You guys decide what to do, where, if you are short or looking to get short, where your stops are. And likewise, if you're long or looking to get long, where your stops might be. I'm going to give you some key developments to watch for, some that have already happened and some that could happen that may either solidify or change my bearish outlook in the market. So this one, again, the technical posture, you've heard me say it before, divergences are not a buy signal, but much more often than not, they do play out for a trend change. So I think there's a lot of tinder, if you will, in the market right now, just waiting for that match to be lit. And that doesn't guarantee there's going to be a fire, that big drop in the market. But I can tell you the technicals are still there. I've been pointing out these divergences for months now, and we've had some spikes in the VIX. And it ran up and back tested that trend line and then got rejected. But it's back now, back at really, really good support, just off that support level. Okay, now we're going to move forward to talk a little bit more about those PPO crossovers. And what I've done here, I'm going to put the histogram back up. Let's take the RSI. Let's move that out of the way to give us a little more room here. Put up the PPO histogram. Again, I've covered this before, but it bears repeating. The PPO is a very close cousin to the MACD. I just prefer it over the MACD. If you don't have a PPO, you can use a MACD. You're going to get similar crossovers. It's going to look very similar. The methodology is just slightly different, the calculation. Okay, so what I've done now is I've zoomed down to, again, I'm making a case that we're in a bear market that started back in November, late November for the Nasdaq, and just about every other index, including the S&P 500, right at the beginning of 2022. That's what I'm working off of here. And we'll see. Only time will prove that right or wrong. If all the real indexes, Wilshire 5000, the S&P 500, all your equal weighted indexes, if they all go over, and considerably take out their 2002 highs, then yeah, sure. Then doesn't mean that it's not going to be a marginal high and then we drop, but it just, it's going to go down in the textbooks as that won't be 2002, early 2022 won't be the highs or the start of the bear market. And, well, I'll get off on a tangent, but, there's also been the biggest surge in inflation in nearly half a century. And when you can play the game if you want to look, and a lot of experts that do this, look at the real returns, not the nominal returns. If you factor in inflation, then any marginal new high in the S&P 500 now, since it's been almost 2 years, is not going to be a true new high. In other words, if you had X amount in the S&P 500 and you get back to where you were on January of 2022 when it peaked, and we're heading into January 2024, right? So it's going to be almost 2 years. And if you have the same dollar amount, if you had 100 grand in your 401k back then, you have 100 grand today, that 100 grand buys you a lot less. But again, that's semantics. Just keep that in mind. And it's considerable too. That 100,000 is purchasing power is a whole lot lower than it was 2 years ago due to that bout of inflation. So the adjusted returns in the S&P would still be down from where it was back then. All right, but the charts we look at are the charts that show the actual value, nominal value. So here we go. This is it. This is what I've done here, and I'm pretty sure I didn't miss any. It's what I've showed you recently on the Nasdaq 100 and the S&P 500, but in reverse. Okay, so and we'll get to those two in a second, but on the Nasdaq 100 and S&P 500, I was showing you the bearish PPO crossovers, because again, going off the the premise, right or wrong, that we're in a bear market with more downside to come. This is we're at the tail end of a bear market rally. And even look, even in a bull market, you can use it. It's those bearish PPO crossovers, which have had a dang good track record. Not perfect, as I always say. There's not a single indicator that is 100% effective. But when I say pretty damn good, it means well over 50% of the time you're going to make money if you've just taken that one signal. Meaning sold your longs when you got the bearish PPO crossovers on the daily time frame on QQQ or SPY, and or shorted the market. And again, I use those in conjunction with other things and other technicals and divergences and support, resistance, trendline breaks, bullish, bearish chart pattern breaks to help, align or get more precise on the entries and exits. But we're going to look at this. So you can see here now where we look at the bearish PPO crossovers on the indexes, which are your big green hills when the PPO is in bullish posture. PPO lines above the signal line, you're going to look at the opposite. You're going to look for the red inverted hills, and then you're going to look for the crossovers, which I've highlighted here in these purple lines. So you can see, and I've gone through them all, I put question marks because these were so low. I told you before, many times I've said, when you get in trading ranges and in these lines, the PPO lines, that's down here. The lines are flattening out, and you really have to squint to see if there's a crossover. You're going to get these small hills, and that's why I put question marks. So really, I don't use the signal then, I put very little, if any, value or weighting on it. So I just wanted to say that's why you see question marks there. But to be complete, I did put all the bullish, the bullish crossovers, because this is the VIX, so you're looking at it in reverse. And you can see I take the purple lines and they come up. And then I didn't do it on each and every one, but this is it. This is when the Nasdaq peaked back here in November, right before November. In fact, again, this is why I'm doing this video. The VIX, in my opinion, has some predictive value at times to identify corrections before they've even started in the stock market. Again, best if that aligns, if you can align a bullish breakout or bullish technical posture on the VIX with a bearish setup or bearish technical posture on the stock market. So you can see this was early November, and again, I think it was November 21st or 3rd or something like that, mid to late-ish November when the Nasdaq peaked. But the VIX smelled it coming up, and I'm just showing you here, if you just purely took this signal and you didn't have any bias, you were a mechanical trader, these lines I just drew from the day you got the crossover. What I did, I just kind of eyeballed it where the VIX closed that day where you had the crossover. Since it's a daily chart, you'd need to wait for an end-of-day crossover in the PPO, meaning your first histogram bar printed after a red inverted hill, you have a green print. And so when I hold my little pointer finger, you can see on that line, which measures it from the low to the high. And again, this is just to give you kind of the scope of these moves, because it's hard to, if you don't trade the VIX, you're probably not familiar with just how fast it goes up in short order. That line tells me that the VIX went up 139.97. So that's 140% in a period of that. Let me see the trend line. Well, I can tell you, I have to do like this to get the date. It's a matter of just less than a month. You can see that November to December, right? Here's one, 102%. There's one that's 76%. Even the smallest, one of the smallest that I have right here, you still had a 15.5% pop. If you waited, didn't get in front of it, you just waited for that signal to fire. So you can, and I encourage you, pause the video, expand this, replicate it on your own if you want. Here you had a little whipsaw, so I put two lines there. And either way, even if you took the first crossover, it's still from that point, if you went long the VIX, it went up 14%. If you waited for the second one, you see a little whipsaw, and then we cross back green again. It went up even more. That's about 21%. Okay, so this is actually, let me see if I missed one here. That one, yeah, right there. That one would be, no, because if you took it that day, you had the first crossover. Yeah, I'm on the green line. Yeah, you would have took it at the close right here, right there where my crosshairs are, and it went up from that point. It was only a one-day spike, but it went up 27%. So maybe I'm missing something, guys. I didn't go too nitty-gritty through here, but you get the gist. I think, if I'm not mistaken, and again, you can take or exclude these hills I showed you, there's a 100% success rate. You don't always get paid immediately. There were times where the VIX did drop, and this is kind of why I wanted to do this video. We're really stretching the limits of what I've seen. There are periods here. There's a period right here when the crossover came right there. And I did this before I studied. So here's a period right there. You took it right there, and it took about the same period of time right here. You can see we had a little bit upside, but then we went lower, just like right here. Then it took off. My takeaway, guys, and I've been poring over these charts and looking at really with this signal. We're pushing, we're within the normal range of where we can get the signal and not have it play out yet. But again, historically speaking, in the history I'm talking about goes back since the bear market started. We're really pushing about the end of it. So if it's going to happen, it's probably going to happen this week. It's probably going to be everybody has baked in the cake. The Fed is friendly and dovish again, and maybe they are. I don't know, but I can tell you Powell's going to talk tomorrow at 2:30. You're gonna get the announcement at 2:00. They're obviously not going to make any change to the rates, but we'll see. And then there's also some economic reports. CPI came in today a hair hotter, tad 0.1% higher than expectations month over month. No big deal. It caused an initial pullback in the market this morning, but. All right, that's it. Let me not beat a dead horse. This is it. We have the signal. This is your bullish PPO crossover here. You can see all the purple lines. You can replicate this yourself. And I'm doing this because I know I've been beating the bearish drum now for what seems like forever. It's really only been a matter of weeks. It's like blackjack, or any casino game. You got to just put the odds in your favor. If you see something that's worked, 90+% of the time for the last couple of years, there's a good chance. And it's just like, playing with blackjack. If you hit on 17, you hit on 18, you keep, and yes, you get hit on that. Obviously, it depends what the dealer has. You're going to end up losing the game if you just play by, play the statistics. Well, that's probably a bad example because the house, every game, including blackjack, the house has you're going to lose money over time because the odds always favor the house. But you get my point, and it's like this. So you take enough of these shots, and right now, I see no reason to abandon the current short bias and positioning that I have right now. Market's not doing much, kind of just grinding mostly sideways recently. VIX has gone down just a little bit, but that's it. So, all right, let me move forward. Don't want to beat a dead horse, but that is how I see it. And of course, that aligns with this technical posture and these divergent lows. And then what happens is it just goes down, down, down. It seems like the VIX is never going to go up again, and it does. And you can look at these little EKG spikes I call them. They're in it's not a completely predictable pattern, but it's, VIX doesn't stay low for too long. It doesn't stay high for too long either. Sometimes it'll walk down, but you get these spikes, and it's been quite a while since we've had one. So I see one coming based on the charts right now. And if not, then this is going to be the first whipsaw on that indicator that we've had in years. If we just go down for a matter of, let's say, several more weeks or another month or two, then it's just, we're going to say, you know what, it was a false signal. We'll probably get a whipsaw, and then it may come, and it'll probably come on the next green one. So what I'm saying there is you get some red bars here. We cross back down, then we cross over, and you can go back and look at the few times that you had these little whipsaws. Again, this is when the signal came. We're looking at the bullish crossovers. Alrighty, now let's just do it on QQQ. And let me find that board. That's not it. I actually have this one right here. I actually did some additional annotations for you. Okay, again, we are looking at, we're going back to when the Nasdaq 100 peaked. It was right there. I'll tell you the exact date, but the crosshairs there was November 22nd. The S&P and everything else peaked right here, and the Nasdaq had almost just a slightly lower high. And you know, we're still below that high in the Nasdaq 100, and we're well below that high, you know, the previous bull market peaks on all the equal weighted and normal indexes. Remember, the Nasdaq 100, it's not your typical index. It's more of a sector than anything. It's because it's so heavy in tech, over 50%. But again, it's a trading vehicle, so that's what it is. There it is. And what I've done here is, well, first let me point out what I noticed today, and I've circled it, an uncanny similarity between the final leg up in the bull market, the previous bull market, that leg up from early October, it looks like, or late September right here. Look at this. You had a sharp leg up, unidirectional, a little pullback, and one more thrust up. And that does, what that does is just blows out the shorts. And I've always said this, you know, for a big correction or a big drop in the market, you have to blow the shorts out. You can't have a high short interest on a stock or the market because shorts are the only guaranteed buyers. They cover. When you get all these dips, shorts cover. But when you don't have a lot of short interest, you don't have the short sellers covering and putting a bid underneath the market. And that's where they get the big drops from. And so either way, that's what happened then. Let me turn this volume of price indicator down a little bit. Just kind of keep this chart clean. Okay, so again, look at that. Compare it to this move here. You can almost, if I could cut and paste them, they would overlay almost perfectly. In both scope, there's scope, and duration. Duration's the amount of time. The move was 17%. I measured this one today, 16%, almost exact. And it tells me on here, and I'll show you how you do it. I mean, with the TC2000, you could put the crosshair on the day on the low right there. Actually, you got to get those lines out of the way. Grab the low, it'll snap to it. See how the line snap to it, and then move to the high, and it'll snap to the high, and that shows you on the bottom box 17 point. No, I might not have been on the. Yeah, 16.67. That's it. That's where I came up with the 17%. And you can see in the white letters on the bottom, not annualized. Look above that. You can see 1.6 months, 35 bars. And then you go here, snap that, get that out of the way. Once it's snap and grab it. Now I got it. See, I have the bottom of the candle. See a little dotted dash lines. And there it is. So 16.06%, 1.6 months. So this, I didn't draw this really to be a trend line, just to show you. You can also just put your little thing on there and see the gain right there if you do it. And you do have a trend line, actually. You know, I can put them like trend lines. There it is. There's a trend line there. There's an uptrend line there. And, yeah, that was it. That was the high right there in the market. And now let's talk a little quick study on the PPO. Oh, and before we move forward, you know, I love to do that was then, this is now. Oh, and well, a couple things. Also, look at the posture of the PPO. Look at the PPO. It looks exactly was coming from this level right here. I'll take that across right there. It almost mirrors the PPO back then. So it's almost too similar that makes me think it's not going to work out, because my goodness, sometimes when you see something that's exactly the same, well, they're not going to work it. But whatever. I'm just pointing out the similarities. You can take it or leave it or do with what you want with it. And then, of course, the PPO crossed over. Looks like here you had it was about to cross. You got a little, that last gasp there. You put in the bearish engulfing. And now, you know, that was back then. here's where we were at back then on the site. We had that was what did I tell you, the 23rd, I think we had it. So the closest I have here's one stock index and ETF futures charts. This goes again back to that period of time. It was November, so November 29th. Here's SPY, here's QQQ, NQ. Let's just pull up this QQQ chart. So at that time, remember, there's the top. There was a bearish engulfing candle. We had sell signal 1. We got in a little early, pointed that out. This was a short. I had targets for you. And then sell signal 2 on the even larger, more significant trend line. That's identical to the trend lines I just drew for you on the daily. And then and this is what I posted on the 29th after we were already short. We were short the highs. We were short a little early, but stayed with it. And then said next sell signal to come on a break below 390. And there I give you at this point in time, we had 4 pullback targets, right, on the 60-minute chart, which were that would take us down if and when my 4th target was hit. That was 369.50. So let's go back to the chart. And now that would be 369. Here's 370. So I put a horizontal line right there. So that's when that 4th target was hit. Now, bear with me, guys. That was back in November. We were shorting off the high, and I was calling the market down to right here on the 60-minute charts. But if you go back to all my analysis from the start of the year, I continued to reiterate and then focus on and give you long-term charts where I then laid out the same targets that are in play today, these right here. Calling for a bear market, saying the 60-minute chart was our timing to get in. I had those near-term targets for quick swing traders, just like I do right now, no different. 60-minute chart, we have these same targets. This is almost identical to back then. T1 was already hit, T2, T3, T4. But as with back then, if and when this starts to pan out, I'm already open to those longer-term targets that I've given you. And in fact, they're the same targets as before. We just never hit T4. We hit back then. We went on to hit when the market topped my 1st, 2nd, 3rd target. 3rd target was 268-ish and or the trend line, which there's the trend line, the white trend line. It was hit perfectly. We bounced. And so that's the bear market rally. And now next target should take us down to my 4th target from all the way back here. We'll see. But again, the takeaway is, if you agree, there's that negative divergence on the almighty, all significant weekly time frame right there. And now let's wrap this video up and get back to the PPO crossovers. So what I did a little different now. The other day I told you I like these big green hills, I call them, on the PPO. And again, that's when the PPO makes a bullish crossover. When the orange line, which is your PPO line, crosses over the white line, which is a signal line. You can see them here by looking at the crossovers, but the histogram just shows you visually when the 2 lines cross. And so I'm just going to draw it out for you real quick. And what I'm doing here, again, and I've done this in the past few weeks, I'm just showing you the track record of this indicator. So remember, we had 101, or not 101, but we had several reasons to be short, and we were short the highs based on the 60-minute charts. There's that secondary trend line. This was on that 60-minute chart I gave you back then. There was the near-term trend line. That was our first sell signal right there. We pushed up, made a marginal new and divergent high. Then that got that second sell signal. And then the third one in that chart I just showed you, whatever that horizontal level we needed to break, we broke it. And that's when we hit that 4th and final swing target. But at that point, I was in trend trading mode, giving you those longer term targets and saying, we're going down here, folks. We're going here, here, and here. I think those were where we traded. And we did. We got all those counter trend rallies. We covered, if you were an active trader, I posted covering shorts, going long based on a lot of things. This stuff I'm doing now, this bullish crossovers, bullish divergences, oversold conditions, bullish candlestick patterns, trendline breaks, yada, yada, yada. And then, of course, shorting rallies back into the 200-day moving averages, which we did there. And then that was the breakout above the 200s. Okay, so the track record for these bearish PPO crossovers. If you took that one, again, I'm playing the game high to low, and we did, that's where the 60-minute and 15-minute charts and daily charts and other things come in, where you can game these bounces, but I'm just showing you the moves that followed each of these crossovers. That one started to play out, had a reversal back to where it was, or a little bit above where the crossover came, but then it did certainly play out. That one gave you that. That one didn't have a whole lot, but if I'm not mistaken, and I can go back, I'm almost certain we were long there for reasons covering shorts. Maybe I'm wrong. Yeah, no, I know I'm not. I remember gaming almost that rally with near impunity, just like that one, right up to the 200 days, reversing back short. There was your next sell signal. There was one that came right there. We're going to say a fail maybe because that's the candle right there. There was your bearish PPO crossover, but that was the bottom of the market. I'm not mistaken. We were covering shorts there, going long, and so that one we'll say it didn't pan out because it did this. That next bearish PPO crossover, you got it right there. Market pushed just a hair higher, and then we had a big leg down into the January lows. That's where I went uber bullish and long all the big fangs, overweighting the Mag 7 stocks, saying they'd outperform, picking some of those individuals my favorite. And so we were very long and strong off that low and short heading into it, actually, down into it. So you can see the track record. You can see it visually. The purple line is just where we reached these extremes up here, right here. That's the purple line. And so that's why I made these purple lines here. And the yellow line at about 0.49 is right there. So that shows you these smaller hills right here, like this one, this one, this one, this one, and this one. So typically the bigger the hill, because you're in a stronger trend, the bigger the ensuing reversal will be. But a lot of times these little hills did the trick, even recently. Again, these were bearish PO crossovers. If I'm not mistaken, I pointed out at least a couple of these recently. And so all of them gave you as a swing trader, except this one here. This one, I'm going to say, even though there was a little down, well, went up, then it went down a little more. It certainly, you didn't make a whole lot being long. You went sideways from that point. There was a little down. And of course, this was a strong uptrend as well. I'm just showing you them all. You can screenshot this. You can replicate it. Here's the bottom line. We triggered recently. And again, like I said before with the VIX, we're pushing really pushing the limits because normally, and that's my analysis, normally when you got the signal, you were either already going down or you went down right away. But there are and were a few exceptions where you went on for about a week or two and then the turn came. So again, my takeaway is this is either going to prove to be a whipsaw and only time will tell, and we'll know within next few weeks, or it's going to pan out. And if it's going to pan out, I really think it needs to pan out soon, is in hammer down starting, or at least the downtrend solidly starting this week would be my best guess based on extensive analysis of how this has happened, the crossovers in the past. Okay, the S&P 500 SPY. Let's go to this board right here where I did these lines for you as well. I'm just going to show you. I just did them all in purple. I didn't set the extreme. I have an extreme line in white here. Again, that's the big hills. We're a little bit shy of that one there. But you can see these are all the bearish PPO crossovers since the bear market started. Even before the S&P, remember, the S&P, unlike the Nasdaq peaked here, and the S&P actually peaked here. But back in November, you had a shot across the bow. And there was an example. There was a crossover came there, and there was about a week or so. You can see it. Hopefully you can see it here on the video. There was about a week that we kept going higher. And then the correction came. There was a crossover, and it was just down from there. Really ought to wait to that point. There was another crossover there. That was sort of a little hill. These are the ones you might want to ignore. There is your crossover. You're down. Crossover, a little down left. That was after a big rally, big counter trend rally that really took that, because it was powerful. In a bear market, bear market rallies are swift and strong. There is a down. Look at that beautiful signal. Boom, caught all that. That one, here's a good example. The signal came, the market went higher, even slightly, for just about a week. You can see, let me count them for you. Let me scroll up here. Signal came that day. We had 1, 2, 3, 4, 5 days. It kind of went sideways to slightly up, one big blow off top, took out the previous highs, charged up the bulls, sucked in some new cash on the long side, blew out the last of the weekend at shorts, and then boom. From that point, whoever bought that high lost 9% over the next week or so in the drop. So that signal certainly played out. Again, depending on, are you taking it literally with a stop right there and then you got stopped out? Or do you give it a little room like right now? All right, so that's that. That one certainly played out. That one did not, I'm going to say. And that's what stops are for. You got at least a stop would have been probably right about there. And again, you look at all the other things, all the other technicals, 60-minute time frames, daily time frames, trend lines, support, resistance level, Fibonacci's, everything there. But again, I drew enough arrows. The track record is pretty solid. And I'm going to say that's well over 90% success rate on that signal. And here we are. We got it in the S&P. Oops, I messed that line up. I'm actually just put this up on the S&P today. There it is. Let me make sure the two align. No, they don't. So I move that over one day. Now I put the crosshairs. I see they align. So the signal on the S&P confirmed just last week on Wednesday. Today's Tuesday. So it's only been since the sell signal was given 1, 2, 3, 4 up days. And so certainly within the norm. But again, to see it go up another couple weeks, then we're just going to say we'll have no choice but to say it was a whipsaw. As of now, it's a sell signal that was triggered, and do with it what you want. Oh, here's something I should have had for you. I put whipsaw here, and I should have had the line, and I didn't. And I'm going to put the line right there. And here's another example of why you look at other things other than just this. So that happened on June 23rd. The lines were headed down, looked like they were going to cross. And back here, when you go to the website on June 17th, a few days before that, you can see that I was waiting for a breakout. Had my arrows going up, obviously either already long or looking for additional buy signals, looking at that bullish falling wedge. And so this was telling me, the other technicals were telling me at that time to get long. There's NQ, active long entry, drawing arrows up, and that was June 17th. And again, you can see it in SPY right there. That was, that indicator I would have ignored at that time, and I did ignore. And so when we caught that and we were profitable, there it is. And nope, I had it on this board here. Nope, not that one, that one. There it is. There it is. There's the June. There's that crossover right there. June 22nd of 2022. And I ignored it because the other things were telling me to be long. And so that's why I wasn't highlighting the bearish PPO crossover at the time. I was highlighting bullish falling wedges on the 60-minute chart. Okay, guys, I'm going to wrap it up here. Take it or leave it. Just know it's going to be a volatile week. And there are no guarantees with this stuff. But I just spent 43 minutes telling you why I still maintain a bearish outlook, both near term, meaning that 60-minute chart pullback, and longer term. And remember, and that's another takeaway, just like back then, and when the market topped, it all starts with a seemingly normal pullback that everybody, I'm listening, even bulls right now are saying, yeah, market's got a little hot and needs to pull back and correct. So, if they get that, they're going to be buying there. And then that's where we're watching. That's where either, that if we just do this and I'm wrong, everyone's wrong, market just keeps going up. But if we pull back here, and I think that's what we'll see again, and then the perma bulls will be buying right there, or those bullish, won't call them perma anything. That's it's a term some people are bullish at times and bearish at others. But that's where we're going to see. So we'll watch that. If and when the next pullback comes, we're going to watch to see if does the market bounce where it quote unquote should bounce. That's where I say where bulls should step in. They stepped in at my first target, T1, and bought it. This is the current uptrend line. This is your current bearish rising wedge, just like I gave you back in 2021, right when the Nasdaq was peaking. We got in early back then too. We hit that first target. We had other reasons to be short there. And then, do they step in and buy here? because that's where they should buy it. Backfill that gap. Remember, I've been talking about this gap right here. And so bulls should buy that. And if they don't, okay, then they should buy my next target. And if they don't, at the very minimum, they should buy a pullback to back test those primary downtrend lines. These are major trend, well, off the July highs. And again, they should, quote unquote. Not saying they will, they might, but if they don't, then that's going to be very bearish. If you do not see, the buyers don't show up here, 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 and I'm not talking just a quick bounce, and you're going to get little reactions off those levels. But ultimately, if that level goes, and that's probably it. If that trend line goes, that's the trend line off the recent highs, right there. You can see this blue trend line. You know, that's to me. If that goes, you have the 200 days just below it, the 200-day moving averages. That is lights out. This is my lights out for the market level right here, right about. Well, it'll be T3. You know, we already hit. Called, you know, we shorted off here. If you want to say this is still one big short, if you want to look at it that way, and we're barely underwater. If you didn't take profits on T2, I certainly did, and I posted strongly, you know, the case to be long there, cover shorts when we hit the 200-day moving average on not just QQQ, but most of the market leading FANG stocks and go long there. But assuming you didn't, you're back to about where you shorted back here. And this is the next target. And then if T3 is hit, I can tell you I will almost certainly be holding, especially on long-term funds, because if and when T3 is hit, we will have taken out. You might not be able to see them there. There's the 200-day moving averages and that key downtrend line. And that will be, to me, a massive bearish technical event if the bulls step and fail to step in and buy the next pullback to the 200 days in that downtrend line. And if we never get there, guys, guess what? Then you might consider, you know, you should have stopped somewhere, depending, again, where you shorted, because we could just see a blow off, you know, top coming up here in 2024, I'm sorry. I cannot rule that out. A lot of cash on the sidelines. One thing I haven't heard others talk about, and I'm sure they have, but we know there's tremendous amount of money went into those 5.5% CDs. I've got a bunch parked in a 5.25% money market, a bank promo rate through, I think, February or January. And so all those promo rates, all those big 5.5% money market teasers the banks were floating out there to get new money, new deposits, all the 5.5% CDs they sold in the last year or so when rates got high up here, that's hot money. When that rolls, if interest rates continue to fall, and the more they fall, and especially Fed, you know, there's already talk of the Fed cutting rates. Yeah, there's a bullish case. So I can sit here all day long. I'm not going to do it in this video. If you want to hear it, I'll do a video if you ask me to, showing all the bullish signs, all the levels to, you know, I don't really have potential targets. When you go to new highs, there's no resistance levels to target. All you have at that point are Fibonacci projections and things like that. But if you guys want it, I could do it. I'll sit here and talk for an hour of potential bullish developments. But my job is, again, to parse through all the data and point to which is the most likely. And right now, it's still to the downside, guys. All right, I'm going to wrap it up here and get this one out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.